Good afternoon. My name is Ben Arnold, and I'm with the Student Loan Ombudsman Office here at the Department of Insurance, Securities, and Banking, also referred to as DISB. On behalf of Mayor Muriel Bowser, our Commissioner Karima Woods, and our partners at DCHR, the Student Borrower Protection Center, and the Office of Attorney General, and our AG, Brian Schwab, I would like to welcome everyone to this informative webinar. At this time, I would like to turn it over to Lindsay Marks with OAG's office for opening remarks. Lindsay?
Thanks, Ben. My name is Lindsay Marks. I'm an attorney with the DC Office of the Attorney General's Office of Consumer Protection. The Office of Consumer Protection addresses deceptive and unethical business practices in the District of Columbia, including unethical or deceptive businesses as they relate to student loans. Our office investigates these potential violations of the DC consumer protection laws and, when appropriate, files civil enforcement actions. We also offer a free consumer protection mediation program where we work to resolve disputes between DC consumers and businesses without going to court. We're happy to co-host this webinar with the DISB and the Student Borrower Protection Center to bring you all some really helpful information on student loans and return to repayment. Thanks, Ben.
Thanks, Lindsay. And a brief introduction about DISB and how we support our DC residents and DC government employees. We address issues related to student loan debt and obtaining alternative sources of funding for your higher educational needs, or perhaps the post-education, secondary education of your children. Without further ado, I have the pleasure of introducing Winston Berkman-Breen, who is the legal director at the Student Borrower Protection Center. Winston has a lot to cover today and will be speaking to the recent Supreme Court's decision on the Biden-Harris debt relief, income-driven repayment plans, the new SAVE plan, the one-time IDR adjustment, PSLF, Fresh Start, and the upcoming return to repayment. We ask that everyone hold their questions until the end of this presentation. However, feel free to use the chat feature to present your questions, and we will try to answer them to the best of our ability at the end of our webinar. It should also be noted that this webinar is being recorded and will be on our website and also on OAG's website within a few days after this recording. Without further ado, I would like to turn it over to Winston, and thanks again for your partnership. It's all yours, Winston.
Great. Thank you so much, Ben, and thank you, Lindsay. Thanks to your offices for partnering on this and for all the work you're doing for DC residents and borrowers. So again, my name is Winston Berkman-Breen. I'm with the Student Borrower Protection Center. We're a national nonprofit focused on the student debt crisis in DC, at other states, and at the federal level. As Ben said, what we're going to do today, it sounds like a lot, and it is a lot, but our goal is to make sure that you, whether you're watching live or watching the recording, have all the information you need to know right now to start making decisions about your loans, especially before payments resume in October on federal student loans. And we're going to get to that. So we're going to cover a lot. There will definitely be time for Q&A. So as Ben asked, I would just encourage you to hold on your questions until about 12:30, just because I think a lot of the content will likely be covered. And if we can keep those questions out of the Q&A chat, things are going to get answered in the presentation. It then makes it easier for us to go to the Q&A chat at the end and find those questions that haven't been answered yet. So again, just wait for about 20 or 25 minutes till we're close to the end of the presentation part before you add your questions to the Q&A feature. And I see that that feature is working, so that's great. Okay, now, and again, as Ben said, this is if you're just joining, this is recorded and this will be available later. So if you missed something, you can either ask in the chat, or you can wait and watch the recording and share the recording later on with your friends and family and colleagues. Okay, so I am going to share my screen and then we're going to get started. All right, so navigating student loan repayment. And again, thanks to the Office of the Attorney General and to DISB for partnering with us on this presentation. So here's what we're going to cover today. Recent sort of headlines, basically, affordable payment plans and changes to those affordable payment plans, the Public Service Loan Forgiveness Program, what to do if you've been in default, how to prepare for return to repayment this fall, some quick high-level takeaways, and then Q&A. Again, this sounds like a lot. We're going to walk through each of these at the, I think, appropriate level to sort of end the webinar and have a sense of where you need to go or what your options are. But we are trying to cover a lot of terrain. So first and foremost, I don't want to jump in too deep too quickly, but you've probably been aware of a Supreme Court decision at the end of June around student debt cancellation and what that was, and what you might have questions about, ramifications for you. So we're just going to talk about that briefly. So President Biden, almost a year ago, announced a plan under which borrowers could have up to $20,000 in their federal student loan debt canceled if they met certain income and other eligibility criteria. This was going to extend some form of relief to nearly 40 million people of the 43 million borrowers across the country. It was application, sort of opt-in based, and that application was only open for a few weeks, during which time over 20 million people applied, 16 million of whom were deemed eligible, although their loans were not yet canceled. That application was closed because a couple of different parties, including 6 conservative states, sued to shut down the program. And while that case was making its way up to the Supreme Court, the application was closed during that time. So from the fall through to June, oral arguments were held at the Supreme Court in February. And on June 30th, we got the decision that the Supreme Court struck down the president's debt cancellation plan. Now, the president very quickly said that the same day, that he's going to explore extending that cancellation debt relief through other authorities, and announced that process is starting. It's through something called negotiated rulemaking, which is just a process that the federal government sometimes uses when it wants to do new programs. We are still waiting to see what will happen there and what the kind of cancellation will look like and the parameters of that rulemaking. But the sort of status quo as of this moment is that specific announcement about $10,000 or $20,000 of debt cancellation for eligible borrowers from last year is currently on pause and not moving forward. And the administration is figuring out how it can extend that relief to other folks. Now, I wanted to start here because it is top of mind for a lot of people, but I also want to really make crystal clear that the only issue in front of the Supreme Court and that the Supreme Court struck down was whether President Biden had authority to cancel $10,000 or $20,000 in federal student loan debt through that program he announced. None of the other federal student loan programs that we're going to talk about today were caught up in or involved in that Supreme Court decision at all. So those are still very much live, available to you. And in many, if not all instances, the other programs that are still available extend complete cancellation or affordable repayment, whereas the president's announcement, while very important for many households, for other households, $10,000 or $20,000 of cancellation wasn't doing much, right? So the rest of this presentation is all about what you can do today or what's coming down the pike very shortly to help either get debt cancellation on your loans or prepare for repayment if you're not eligible or yet eligible to have your debts completely canceled. So the main takeaway on the Supreme Court stuff is that, TBD on what the president will do as a follow-up. He's working on it, but don't sleep on this, right? Because you have a lot of other options under the federal student loan program. Okay, so we're going to start with what some of those options are, and we're going to talk about something called income-driven repayment, and then the SAVE plan, which was a recent announcement. Again, if you have questions during this, save them for a little bit to see if they're addressed, and then put them in the Q&A if they haven't been addressed yet. Okay, so what is income-driven repayment? So there's actually several repayment plans under the federal student loan. We're talking about federal student loans right now, not private student loans. For federal student loans, there's multiple plans you can use to make your monthly payments. You get put onto a sort of a default plan that sets your monthly payment based on how much you owe and how long you have to pay it off. You owe X amount and you have to pay it off over 10 years. They just divide that up and figure out what your monthly payment is. There's an extended plan where you pay the same amount off over a longer period of time, so that lowers your monthly payments. Something called the graduated plan, where it starts with low payments and then it ends with high payments. What we're going to focus on, and what is usually the most helpful for people, is something called the income-driven repayment plan. That's represented on the bottom right there, but we're going to focus on it over the next few slides. So IDR, or income-driven repayment, is actually it's an umbrella term for a suite of different plans. And what they all basically function the same way is, rather than asking how much you owe, they set your monthly payment, based on your income. What they do is we'll get into the formula in a second, but they say, based on how much you make, you should pay this much each month. And if after 20 or 25 years, depending on the plan and on the kind of loan you have, you haven't paid off your whole loan. Let's say you had very low monthly payments and you haven't paid off the whole loan. At the end of 20 or 25 years, your debt will be forgiven. It'll be canceled at the end of that time. So I mentioned that it's an umbrella term. The types of plans available under IDR are income contingent repayment, ICR, income-based repayment, IBR, pay as you earn, PAYE, and repay as you earn, REPAYE, revised pay as you earn, sorry. That last one, repay, has generally been the most affordable for folks. And it is part of, in a couple of slides, we're going to talk about this in detail, but it has been revamped this summer and is now going to be known as the Saving on Valuable Education, or SAVE plan. I don't make up these names. I'm sorry, they're pretty pathetic in many instances, but the SAVE plan we'll talk about in a moment is actually going to be significantly more affordable than the other plans going forward. But in general, the way that these plans work is they look to your discretionary income, which is defined as an amount of your income, if your adjusted gross income, like what you'd use to file your taxes, above the federal poverty line. So the federal government puts out poverty amounts every year based on the household size you're in. What most of the plans do is they say, we're going to look at 150% of the poverty level, and we're only going to look at your income above that amount, and then we're going to take 10 or 15% of that, right? So it essentially protects part of your income. It doesn't consider it in the equation, and then it takes 10 or 15% of that. This is the general IDR landscape. So these numbers are from last year, I think, but this as an example, it shows you that for a single borrower making less than $19,000, your payments will be zero, because that basically means you aren't making more than 150% of the federal poverty level, which is less than 19,000. And for a family of four, same idea. If you're making 39,000, your payments will be zero. And again, that's because if you're making less than 150% of the poverty level, 10 or 15% of nothing is zero, right? So you can effectively get a $0 payment on an IDR plan. And then if you make a little bit more than that, it's just 10 or 15% of above 150% of the poverty level. So you can end up having very low dollar payments. The Department of Education has a repayment estimator, sort of online calculator you can use to see what you'd pay under each of these plans. Now, historically, there have been some issues with IDR. To start, there was something called negative amortization. Negative amortization is the idea that if your payment is so low, or $0, you're not covering the interest that accrues each month. And so your loan balance will grow. And occasionally that interest will fold into your principal, and then you're doing interest on interest. This is when you hear people who had these, horror stories. If I took out $40,000, now I owe $200,000, what happened? This is what happened, right? They were making low dollar payments, and then their account balance was ballooning. So that can be very emotionally distressing, and it can be problematic to see your account balance go up. But you have to remember, under IDR, the goal is not actually to pay off your loan. The goal is to make monthly payments affordable, and then to get debt cancellation at the end, right? That's the goal. And the IDR, in terms of, oh, well, that's still a lot of money. Like, you can use the IDR monthly payment when you're being assessed for other credit as your debt to income ratio. So the fact that you have a huge ballooning balance doesn't necessarily have to harm you when you want to get other credit, because they'll use your monthly obligation, the lower amount, when figuring that out. So something that's really important to keep in mind about IDR is that you have to certify each year. You have to apply and certify. That way they know what your income is and how to calculate your payment. If your payment ever changes, if your income ever changes, sorry, you can recertify at any time. You don't have to wait for the year. So if you lose your job the next day, you could recertify with a $0 income and then get a $0 payment. And then you don't have to update that for a year. Even if your income changes the next day, that's fine. You can keep that lower payment for the entire year until you have to recertify. But you do have to recertify. And if you don't recertify, you'll get dropped back to a standard plan. And then you'll have to pay that, or go back in and recertify at that point. You're never really locked out of it for the most part. An important thing to keep in mind is that we've been under this payment pause for 3.5 years. Folks haven't had to make payments on their federal student loans for the most part. Those count as an IDR payment. And that's important because you're getting that credit towards 20 or 25 years until you get cancellation. And the federal government didn't want to ding you and say, well, we're not requiring payments, so we're preventing you from getting that credit towards cancellation. So each of these months since March of 2020, if you have the pause, counts towards that horizon of cancellation under income-driven repayment. So I mentioned that they're in a new plan. So the new plan is going to be significantly more affordable than the previous plans. Just to start, they're raising the protected income from 150% to 225% of the federal poverty level. So they're just going to lower payments that way. They're also, for undergrad debt only, lowering the percentage of your remaining income above 225 from 10% to 5%. So this is effectively cutting payments in half for a lot of people. Then if you don't have only undergrad debt, if you have graduate debt, it's going to be 10%. If you have a mix of undergrad and grad debt, they're going to do a weighted average of 5 to 10%. So you'll fall somewhere between 5 to 10%. They're also getting rid of that interest on interest problem. If your payments are so low that you're not covering your monthly interest, they will waive or cancel or forgive whatever interest is not covered. So people under the SAVE plan shouldn't see their account balance going up and up and up and up and up. They're also adding a feature where if you borrowed up to $12,000 for undergrad, they're going to cancel your debt after 10 years in the SAVE plan, not 20 or 25 years. And then if it was a little bit more than 12,000, they'll add a year for every 1,000 up to 20 years. You'll never have to pay more than 20 years if you have undergrad debt. There's a little asterisk next to that second bullet. That's because that is going into effect basically immediately, whereas the rest of these things are going to go into effect on July of next year. So just what does that look like? It means that if someone is earning $32,000 or less, they're going to have to pay $0, or if they're a family earning $67,500 or less, they make $0 payments. That's that 225% of the federal poverty line. And then anything above that, they'll pay 5% on it if it's undergrad debt, or 10%, or a weighted average of the two. So this is a conversion from the repay plan. So how do you get into this? If you were already in repay, you'll automatically be moved over. If you aren't already in income-driven repayment, or you're not already in repay, you have to apply, and it'll be the repay save option. They're converting all the documents over right now. So on a given day, it might say repay, then it might switch to save, but it's going to be the same thing for the purposes of applying, right? So you can apply on studentaid.gov. You can do it online, and you can link to your IRS account, like your tax history with the IRS through that studentaid.gov application as a way to verify your income. It takes less than half an hour, like 15 minutes. It's rather straightforward. I think that's a good move for a lot of people. It also leaves a paper trail. You can also call your servicer and just verbally tell them what your income is if you need to certify or get into a plan right now. Servicer wait times are very high right now, and you don't get that sort of like email confirmation. So if you can access a computer, I would recommend going to studentaid.gov and doing the application online that way. And again, if you were, we'll talk about this later, but if you were already in repay, you don't have to do anything. You'll have to certify your income at some point, but they'll tell you when, they'll prompt you. If you're not in repay or not in any IDR and you want to get into SAVE, you should go ahead and do that soon. Okay, so that's IDR in the SAVE plan. IDR, again, income-driven repayment, and SAVE plan is one of the IDR plans, the new one. So we're going to talk now that we know what IDR is, we're going to talk about the IDR account adjustment, which is not a plan, but is a policy that the federal government is doing. So one huge problem was that the IDR plan promises cancellation after 20 or 25 years, but then it became clear that no one was tracking that. I know that sounds sort of like jaw-dropping. It seems so simple, but the student loan servicers who manage this whole system just weren't keeping track. So there was a study about 2 years ago that found that of the 4.4 million people whose loans had been in repayment for over 20 years, only about 157 of them had gotten their debt canceled at that time. So really, clearly something was wrong. A lot of the issue too was that people were being steered by their student loan servicers away from IDR payments, which would have been affordable to them, and into something called a forbearance, which is a time period during which you don't have to make a payment, but you're not getting credit courts cancellation and your interest will accrue and sort of stack up. That's called sort of forbearance steering. So to sort of remedy both of these issues, the fact that people weren't having their time tracked and the fact that they weren't getting good at information about what plan to be in, the federal government announced a one-time adjustment. Basically, they're going into majority of student loan borrowers' accounts, and they're going to audit them. And they're going to convert any time and repayment, even if it wasn't in an IDR plan, they're going to treat it as an IDR plan. They're going to go into certain forbearances, like 12-month consecutive forbearances, or if you have someone who's used forbearance a lot and they have 36 months cumulatively, they're going to count those as having been in an IDR plan. Any time in deferment, which is another period of non-payment before 2013, they're going to count those. And when I say count them as an IDR, they're not changing your payment history. They're just treating whatever you paid or didn't pay. They're treating that month as if you were enrolled in an IDR plan for the purpose of calculating whether you've hit 20 or 25 years. They're also going to do something called, when you have a federal student loan, you can, through a process called consolidation, you can take out a new federal loan to pay off your old federal loan. It's like refinancing within the federal student loan space. Typically, when you do that, you lose your 20 or 25 years credit towards that cancellation because you've taken out a new loan and you have to start over on that new loan. So when you consolidate, you're sort of wiping the slate clean. What they're going to do through this account adjustment is they're going to look back before you consolidated, if you did consolidate, and count that time on your new loan. So they're giving you the maximum benefit towards cancellation that they possibly can. So who can get this, right? So basically, anyone who has what's called a direct loan is going to get this automatically. Anyone whose loan is getting the federal payment pause right now is going to get this automatically. And then certain other federal student loan types are not getting either, are not a direct loan, they're not getting the payment pause. They have to opt in to get this, and we'll talk about how to do that. But it's something that they have to do, and there's a deadline. But the bottom line here is a lot of people who should get debt cancellation but hadn't had their accounts properly tracked will get it, and then other folks will get credit towards 20 or 25 years of cancellation for income-driven repayment, and then have to apply to save or another plan going forward until they hit that mile mark. Okay, so how do you know whether what type of loan you have and whether you have a loan that you have to do something for or not? So first, studentaid.gov is the main website and clearinghouse for federal student loans. All of your federal student loans will appear there. So if you're ever like, I don't know if this is a federal loan or not, it's a private loan, go to studentaid.gov, create an FSA ID, log in, and then you'll see all of your federal loans, even the ones you paid off. So you're going to log in, you're going to go to view details, and then look at my aid data, and that will give you a download you can look at. You can also, and this is a little bit easier, on the same login, go to your dashboard, and you will see if you click through, you can see your loan types broken out. So here I mentioned consolidation as a type of refinancing. You see that here. You also see down below like a Perkins loan. That's another type of loan. The bottom line is if you see, for this slide's purposes, if you see the word direct, so you see under those two consolidation loans, it shows direct consolidation. If you were to click that 3 Graduate Plus loan, it would probably show direct loan there as well when you expand the view. If it says direct, you're going to automatically get this IDR audit, this IDR account adjustment. And again, you only have to worry about loans where you still have a balance, because otherwise, the loan's been paid off. Another consideration, if it doesn't say direct, what you have to do is figure out whether your loan is owned by the federal government. Counterintuitively, there are federal student loans that are privately owned, and those folks have to actually do something. So you have a government-owned or an ed-held, Department of Education held loan versus a commercially or privately owned loan. So on that same, going back a slide, if you click into these individually, you get a view that's sort of like this. And you can tell if your loan is government held because, like on the bottom here, it shows Department of Ed /MOHELA. And this shows you that the first before the slash is the owner. So this is a Department of Education owned loan, and then MOHELA is the servicer for that loan. Whereas if you go up, it says Wells Fargo Bank. That's a private bank. So that's a privately owned federal loan as opposed to an ed held loan. Any of those loans that are not government held, ed held, you're going to have to consolidate. You're going to have to do that process to get benefit under this program. So again, you're going to go to studentaid.gov, check out your loan type. Loans not held by the government, you want to consolidate, and you have to do that by the end of this calendar year. They're going to begin making adjustments next year towards that 2025 year cancellation horizon, and you have to have consolidated your loan before then to get the benefit of time before you consolidate it. First, they're going to start with people who are going to get full cancellation immediately, like they've had 20 or 25 years, and then they're going to do everyone else. So they actually did just start to do this. They just announced a couple of weeks ago some $30 billion in cancellation for over 800,000 people. That was part of this IDR account adjustment. I will note that someone has already sued over this. As of today, this program is still going well. You should all take these steps if you think they're going to be helpful to you. But keep an eye on the news, because there are unfortunately some sort of private parties out there who don't want this for anyone and have sued in court to stop it. But as of today, this is all full steam ahead. Okay, so that's income-driven repayment, IDR, and then the audit IDR account adjustment they're doing for that. Now we're going to talk about public service loan forgiveness. So public service loan forgiveness is a program that Congress created about 15 years ago, 2007, that basically says if you work in public service, government and nonprofits for 10 years and you make payments on your loan and for that time, you will get the rest of your debt canceled after that time period. There are some specific criteria. You have to have a direct loan, which is a specific type of federal loan. You can see, I'm going to click back some slides. You can see the type of loan here. You can see it says direct here versus Perkins down below. It has to have the word direct in it. You have to be on the right payment plan, and that's either the 10-year standard plan that you generally default to or the IDR plans we just learned about. And in general, most people will get on the IDR plan for public service loan forgiveness. You have to work full-time for that employer, that government or nonprofit employer, and that generally means 30 hours a week, an average of 30 hours a week. And then you have to do 120 payments, which is 10 years worth of payments. You have to do all of those things together. If you leave public service, you can come back to it and pick right back up where you started off. You don't have to start over at zero. If you consolidate your loan, depending on the kind of loan you have, you will either, if you consolidate two direct loans together, that loan type that you need, you will get a weighted average of the time towards PSLF cancellation for each of those loans you're consolidating. If you consolidate a non-direct loan, you're going to start the clock at zero just because you needed to have a direct loan to be accruing credit on this, and not everyone had a direct loan. And we can answer more specific questions about public service loan forgiveness, but the bottom line is between now, well, we'll get there in a slide, but there are steps you can take to make sure you get all the credit you should have for the public service work you've done, but you need to take them soon, and we'll talk about that. As with IDR, the payment pause months count towards public service loan forgiveness, but they only count as the payment part, not the loan type, not the employment type, and all of that. So you're getting a couple free years of payment, but you still need to have the right kind of job. Now, how do the IDR account adjustment and PSLF work together? It really gets to that payment type and loan type, which is important. If you don't have a direct loan, the way to get a direct loan is to consolidate. As I mentioned, in general, when you consolidate, you lose past credit, except for during the IDR account adjustment, they're going to give you credit for IDR for those older loans. Because IDR is a qualifying plan for PSLF, they're effectively giving you credit for PSLF, right? So basically what this means is if you have a FEL loan or a Perkins loan, anything but a direct loan, you're going to have to consolidate to benefit from PSLF. And then you can get a lot of IDR credit towards that 120 payments that you need. In more detail here, to get this benefit, right, you have to do that consolidation step. If you already have a direct loan, you might get more payment credits through the IDR account adjustment. That'll be automatic, but you have to take an affirmative step if you don't have a direct loan to do this. Which means that those non-direct loan borrowers, FEL loan and Perkins loan borrowers, have the most to lose, right? They have the greatest risk. And you have to make sure you take that step by the deadline, the 12/31/23, the end of this calendar year deadline. So Parent Plus borrowers are a particular type of direct loan borrower. They are a direct loan. These are loans that you take out for your child, but you're the borrower. So you're not the student and the borrower the way that you normally are. You're just the borrower. They can qualify for public service loan forgiveness, and they can benefit from the IDR account adjustment, but it's a little bit complicated because to get into an IDR plan, a Parent Plus loan borrower has to consolidate first. Parent Plus loans are not directly eligible for IDR. They have to consolidate. And when they do that, they're only eligible for the ICR plan, not the new SAVE plan. So this puts Parent Plus borrowers sometimes in a bind because if they want to do PSLF, they have to get into an IDR plan, but the ICR plan that they're eligible for can be unaffordable for some people. So it's this catch-22 of like, I want that cancellation, but to do it, I have to do an unaffordable payment plan. Some people might just choose to pay down their Parent Plus loan. It's a pretty individualized decision. So it's hard on a webinar like this to sort of tell you if you're a Parent Plus loan borrower what to do, but you might want to seek out individual advice based on your household finances and what's affordable to you. And just keep that in mind before you decide to consolidate your Parent Plus loan, because you might only have the income contingent repayment plan, ICR, as your PSLF qualifying plan, and that might not be affordable for everyone. Okay, and remember this important deadline for PSLF is like the IDR account adjustment to consolidate if you don't have a direct loan. All right, so this is just the summary, right? Check what kind of loans you have on studentaid.gov, consolidate any non-direct loans before the deadline. If you have a Parent Plus loan, be mindful of the fact that ICR will be your best payment plan for PSLF. So check using the payment calculator what you think that will look like for you. And then with PSLF, you have to always I didn't mention this, but you have to always certify your employment. The government actually doesn't know where you work unless you tell them, the Department of Education at least. So you have to get your employer to sign a piece of paper. It's two-sided, it's very simple, and get them to submit that. We recommend you do that annually so you can track your progress towards 10 years. We have other webinars that you can look that are an hour-long, focused exclusively on PSLF. So the purpose of today is not to walk you through all the mechanics of it, but to make sure you're aware that it's a program that can help you and to make sure you're aware of upcoming deadlines. So if you have follow-up questions on PSLF, you can see them in the resources at the end and in the follow-up resources that are available to you. So definitely more help is available. I just want to make clear the distinction between today's webinar, which is hitting multiple programs at a medium level, versus other trainings and resources that go into greater depth for each of these programs. Okay, so that's PSLF. Now we're going to talk about something called Fresh Start. So Fresh Start is really an amazing program for people who are in default on their loans. They have just struggled to get out of default. They've been in default for years. This is, as the name suggests, a fresh start for them. So what it does is it restores their repayment options. So when you're in default, you don't have typical monthly payment options, so you can't get onto like an affordable plan like the Save plan. Through Fresh Start, you will have access to those plans. So you can be put back in good standing and then immediately be able to access a more affordable payment plan. It also immediately restores your federal financial aid eligibility. When you're in default, you don't have access to new student loans or new grants to go back to school. So if you never finished your education and you defaulted, it's a really tough position to be in because you can't then go back to school to get the job to pay off the defaulted loans, right? So through Fresh Start, that changes. You'll be able to go back and take out new federal aid to go to school. Normally, when you're in default, you can get out through a process called rehabilitation, but it's a one-time opportunity. This doesn't take that one-time opportunity. It's sort of a special, separate one-time opportunity, which is important. If you do Fresh Start, some of your past negative credit reporting associated with this loan will be fixed, which helps your credit. And any what's called involuntary collections you're experiencing, if your wages are being garnished to collect on these loans, if your tax refunds or benefits are being offset, that will stop and your loan will be essentially considered back in good standing and you can get on a payment plan. So who's eligible for this? Basically, anyone, so you have to have defaulted before the payment pause. And this is in part because people who defaulted during the payment pause have been put back in good standing as part of the payment pause. So it's been effectively impossible to default over the last 3.5 years. So this program is for anyone who defaulted before the COVID-19 pandemic and the payment pause. You have to have a direct loan, which we talked about, or one of those other loans, FFEL, Federal Family Education Loan, whether it's government held or privately held, doesn't matter for those two, or a government held Perkins loan, which is a loan made by your school, but with a government through a government program. So ineligible loans, another way to think about this, are school-held Perkins, those school loans that are still with the school. There's other ways to get out of default for those. And then a couple discrete programs like the HEAL loan program, which is a very small program, loans that have already been put to the Department of Justice for some special collection purposes. And then any loans that default after the payment pause ends, which we'll talk about, but this is coming up soon. So that's most loans that are currently in default will fall under this eligible bucket. All right, so how do you access it, right? You have a year to benefit from this from when the payment pause ends, so through next September. And you have to do one of two things. You either have to call your servicer, and your loan, when it's in default, is with some special default servicers. So whoever's been communicating with you about your defaulted loan, you can go on studentaid.gov and check. They are the one you have to contact and ask for Fresh Start. Or you can just apply for federal financial aid if you're going back to school, and that will trigger through the school route, that will trigger all the benefits that we talked about. If you don't do this within the 1 year sort of timeline from when payments resume, your loan will stay in default and will have the original default date. So you'll go back into that involuntary collection that we talked about. So it's really important. It's not fully automatic, unfortunately, but it's a really valuable opportunity for you or anyone you know who has been experiencing default on their federal student loans from before the payment pause. Okay, so that's Fresh Start. So now we'll return to repayment, and we're sort of rounding the corner to the end here, and we'll have plenty of time for Q&A. So if you have questions about the programs we've talked about already, you can start loading those up in the Q&A, and we'll get to those. Return to repayment. So as you are likely aware, we've been in this federal payment pause. That is for loans that are owned by the federal government. So all direct loans. And then again, those loans where when you look, it says Department of Education for the FEL or Perkins loans, as opposed to other loans. At this point, also, most people know whether they've been getting the payment pause or not. Some people got shorter forbearances, but for the most part, you're aware if you haven't had to make a payment in 3.5 years. So what do we need to know about this? So it will end at the end of this month. That means that interest will start to accrue on September 1st, and payments are going to start to be due in October. You will get a bill before any payment is due. It has to be sent out 21 days in advance. So this will not be a surprise. Doesn't necessarily make it affordable. I don't want to downplay that, but you will have some notice, and you're hearing it here right now. You want to make sure your contact info is up to date. People have moved around over 3 years. Plenty of things have happened. So you can go to studentaid.gov to do that. And if you have a servicer, direct servicer website login, you can go there and update your contact info there as well. If you've made a payment since during the pause, since March of 2020, those payments are refundable. You might ask, like, why would I want a refund of that payment? I want to pay my loan down. Well, for all the programs we just talked about, IDR, PSLF, if you're like, I actually might be able to get my debt canceled, or I plan on making very, very, very low payments for a long period of time, 20 or 25 years, I don't want to diminish how long that is. You might say, well, I'm going to get some debt canceled one way or the other. So I actually don't care if I made a payment on my balance, I'd rather get a refund and put cash back in my pocket. So if you call your servicer, you can request a refund for payments that you voluntarily made over the last 3.5 years. And again, that only makes sense if you think you're teed up to get cancellation through some of the programs we've talked about or some other programs. The IDR recertification, I said you have to recertify your income every year. Those recertification deadlines have been extended, so no one's had to recertify since before March 2020. You will get notified when you have to recertify your income once payments resume. And currently, again, they're allowing for verbal recertification if you call, although I still think it's better for folks to do it online from studentaid.gov. It just is more reliable. And then if you were someone who was using automatic payments, that should be turned off, like debiting from your bank account, but keep an eye on it and just confirm if that is not happening and tell your servicer to stop it. So what are some things to keep in mind, right? The government has announced when payments resume what they're calling a 1-year on-ramp through September of 24. This is not an extension of the payment pause. Bills are due. You are expected to pay your bills. Interest is accruing, and none of these months will count towards IDR or PSLF if you don't make a payment on them. But if you miss a payment, they won't ding you on your credit report. They won't count it towards time that it takes to reach default. So for federal student loans, you need to be behind by 270 days, and then they consider you in default. They're basically not going to start that clock for a year. So if you miss a payment, you're not going to start a delinquency. They're just going to put you in a forbearance for the month that you missed. So this is really important for people who cannot make a payment, or people who, I think they've hit cancellation and are just waiting for their application to be processed and don't want to make 2 or 3 months of payments while that process is happening. But it's not a great alternative for people who want the payment pause and want it to continue, right? In that instance, you should just get into the save, repay, save plan, right? Because if you're low income, you can get a $0 or much lower payment. And if you're not low income, but you still struggle with your payments, it will still cut it in about half, right? So the on-ramp is really a safety net, or in some very specific instances might be strategic to help you get, if you're waiting for debt cancellation. Otherwise, if you're worried about being able to afford payments, check out the save/repay plan. Okay, so here's some important takeaways. I'm going to show you a slide of resources, then we'll have over 20 minutes, it looks like, to do some Q&A. What are the big takeaways, right? Figure out what kind of loans you have. Direct loans, and if they're not direct loans, are they owned by the government or are they not owned by the government? If you don't have a direct loan, you might want to consolidate by the end of this year, right? And that's to make sure you get the benefit of the IDR account adjustment audit, but also if you're a public service loan forgiveness candidate, you work for the government or you work for any nonprofit, certain nonprofits, any 501c3 and certain nonprofits and any government across the board, you need to have a direct loan. So you might want to consolidate your loan to get that. And if you do it by December 31st of this year, you won't lose past credit that you otherwise might lose. If you're worried about affordability, enroll in SAVE, you can get a $0 payment and your interest won't accrue. Be sure to certify your income if you are, certify your employment if you are a public service employee, public sector or nonprofits. If you're in default, take one of those fresh start steps, call your servicer or try to go back to school and take out aid. During this time, be really aware of scams, right? There's a lot of change happening right now. Payments are resuming, Supreme Court cases, et cetera. So you might get a call from someone saying, we're the government, we want to help you with your loan, or hey, there's a government program, we can help you. The government will basically never call you, right? Like if you get a call from someone saying with the Department of Education, hang up, go online, check your account. If things look normal, you should be fine. Really don't answer the phone and then agree to something or pay someone any money because they called you. All the things we talked about today also are free. So if someone approaches you and says you can pay me and I can help you do this, only do that if you make the decision that it's worth it to you to pay someone, like the way you might pay a tax preparer, right? But in general, I'd say go to studentaid.gov and do this. And I'd be actually very wary of paying someone to do this because they might not actually do it, right? So on the one hand, it's a white glove service. You might decide you want to offload it to someone, but on the other hand, it's a very scam heavy industry. So I would just recommend you go to studentaid.gov and do all of this yourself. And then file a complaint. If you've experienced a scam, you're not going to be the only one. Both DISB and the OAG, who are co-hosting this today, take scam complaints, as does the Federal Consumer Financial Protection Bureau. So I'm going to end on this slide before we start the Q&A, and just some relevant websites and resources. So studentaid.gov, we've mentioned a couple times, is going to be the one-stop shop for your federal student loans. The Office of the Attorney General, you can see their website here. You can also just sort of Google the DC Office of the Attorney General student loans, and you'll get to their student loan specific website. You can get to their complaint page too from that same link. And then Ben at the top of the call mentioned DISB as a resource, and you can see their contact information here for student loan assistance, including an email for dcloanhelp@dc.gov. So with that, my colleague Amy Salata is going to join me from the Student Borrower Protection Center, and we are going to start going through the Q&As. Again, I'm going to take this presentation down so we can focus on this. Hopefully we can get through all your questions, and thank you all for your patience as we got through the presentation itself.
Yes, thanks so much, Winston. We're getting a ton of great questions. Thanks so much. So I think we'll start with income-driven repayment. Can you remind us, I know you mentioned this, but can you remind us like how it works from year to year? If your income changes, what can you do? What is the timeline for that?
Yeah, so in general, you have to certify your income annually for income-driven repayment. I say in general because the payment pause complicates that, but in general, you do it once a year and they notify you, and that's what you have to do, and that's how they set your payment. You only have to do it on that annual anniversary 1 year out reminder, but you can do it whenever you want. So if your income goes down, you can recertify immediately, and then you'll benefit from that lower payment based on your lower income for an entire year. If your income goes up, you could recertify, but it doesn't really make a lot of sense because your payment will go up also, and there's no obligation to. So it is completely appropriate and permissible for you to, again, my example was lose your job one day, recertify that you have zero income, and then get a year of $0 payments that count towards cancellation. Even if a week later you get a job and you're making twice as much as you made before, there's no obligation to recertify immediately with that new income. You can wait, and then the next year they'll capture that. And then for the year after that, they'll base it on that income that you certify. So it's completely above board to do that. The only thing to keep in mind is, again, if you're getting that lower or $0 payment, you're not going to be paying off your loan as fast. But if your goal is to get to cancellation, not to pay off your loan, that shouldn't be a problem. If your goal is to pay off your loan, then maybe you do want to recertify based on your higher income, or maybe you want to keep your lower $0 payment, but then just use your cash that you have and make a lump sum payment and just try to pay down the loan aggressively that way. So it depends on what your goals are, but in terms of certifying your income, you only have to do it once a year, but you can do it voluntarily whenever you want.
Thanks, Winston. And can you remind us what the timeline is for cancellation under the IDR plans is?
Yeah, so it varies based on your loan type. So for undergrad debt, this is sort of broad strokes, but for undergrad debt, it is 20 years under most of the plans. It will be 10 years for undergrad only debt under the SAVE plan if you borrowed only up to $12,000 originally. And what I mean originally is like, what was the principal that you borrowed, right? Not how much do you owe right now on your undergrad debt, but like how much did you owe the moment you graduated or left school, right? If you didn't graduate. If that was less than $12,000 under SAVE, you can get cancellation at 10 years, and then an additional year for each $1,000 that you borrowed for undergrad debt, up to 20. If you have graduate or Parent Plus loan debt, it's going to be 25 years.
Thanks so much. And for figuring out those monthly payments, do they take into account where you live?
They do not, and they do not take into account expenses. So again, we think of it as the affordable plan. It's really the more affordable plan. And as I mentioned, like the sort of emotional distress of people on those plans historically, seeing their account balance go up, that aspect should go away with the SAVE plan's interest rate sort of waiver if you don't pay the whole interest. But it is still distressing to discover that your affordable plan is still unaffordable. So I want to recognize that, but it doesn't take into effect expenses or locality. It just is how much do you make and what is the federal poverty level and how much is left after that.
Thank you. And then for getting into these IDR plans, what if you have FFEL loans? Can you be eligible for IDR plans?
So FFEL loans are eligible for some of the IDR plans. They're not eligible for the SAVE plan itself, the new, more affordable one. But if you consolidate your FFEL loan, you will have a direct loan. You'll have a direct consolidation loan that you use to pay off your FFEL loan. And then that loan will be eligible for all of them, including the more affordable SAVE plan. And if you do that before the end of this year, by that December 31st deadline, you will effectively not lose anything. Normally, again, when you consolidate, you're restarting the clock for the most part. And if you do this by the end of this calendar year, thanks to the IDR account adjustment, that should be fine. Now, again, that's as of today. It's a very frustrating and concerning that in this space in particular, there have been a lot of very private sort of conservative interests that keep suing to change these programs. So people have been making decisions based on what the government tells them, and then a judge comes in and changes that calculus a little bit. But as of today, that is the case. So if you have a FFEL loan and you want to access the more affordable plans, for the most part, if you consolidate, that'll make you eligible for that. There are always some individual characteristics or personal financing that makes it hard in a forum like this to tell you all, yes, you should consolidate. But for most people, consolidating their FFEL loan will only be beneficial, and then they can access more affordable plans and public service loan forgiveness if they have the right job.
Thanks so much. And I think moving on to like the SAVE plan now, I think, will graduate debt ever get canceled under the SAVE plan? Like, how does it work with undergraduate and graduate debt? Yeah, graduate debt will get saved. It'll just be at that 25-year mark as opposed to the 10 or 1 year for every $1,000. Up to 20 years for undergrad debt. So graduate debt is basically always going to be at the 25-year mark. And graduate debt will still get the increase of the federal poverty level up to 225. And if it's graduate debt mixed with undergrad debt, it'll have a weighted average between 5 and 10% of how much of your income after 225 is used to calculate your monthly payment. But the horizon for cancellation will always be sort of fixed at that 25-year mark. Thanks so much. And under the SAVE plan, will they be retroactively taking away the interest that is accrued in like past years? They will not be. So this is just about going forward. As you make a payment, if you have any interest from that month that wasn't covered, that will be waived. They are not going back in and figuring out what folks could have had waived if this were in effect previously. But again, if your goal is to get cancellation, it's a little bit, it feels, I don't know, it can feel like a sort of bizarre thing to do, to not worry about the balance of your loan. But if your goal is to get to cancellation, focusing on making sure you have an affordable monthly plan and then getting cancellation ultimately is okay, even if you have previous interest that is sitting on your account. Amazing. So I think moving on to the public service loan forgiveness program. So how do monthly payments work? How do the 120 payments work? You know, if you make multiple payments in a month, will all those count towards public service loan forgiveness? No. So you have to, because it's not just payments, right? It's also employment. You need 120 months during which you had the right employment and you made a payment. So you can't sort of stack up
You can do it for up to 12 months at a time, but that doesn't, there's no way to get PSLF faster than 10 years. That's the bottom line. It's like, it's 10 years, no matter how you want to make the payments. There's no way to do it faster than 10 years. And you can run into some accounting issues if you try to make multiple payments all at once. So for most people, it's just going to be straight and narrow, make your monthly payment while you have the right job. There's no way to sort of hack it to get done faster.
Okay, thanks. And what about for folks who have already submitted their public service loan forgiveness forms and they're just kind of waiting, you know, are these wait times kind of typical?
So we didn't mention it in the slides because it is closed, but there was something a year and a half ago-ish called the or throughout 2022, I should say, called the Public Service Loan Forgiveness Waiver. It was extremely similar to the IDR account adjustment that we talked about today, and practically for most people has the same effect. So if you didn't hear about this waiver in time and you're frustrated by that, you can get basically the whole same benefits through the IDR account adjustment. Basically, it was a way for people to get credit for past time towards PSLF that they weren't yet getting credit for. Because of that, there was a huge spike in PSLF applications. And again, it's either people who have hit the 10-year mark or who are doing the annual employment certification. The employment certification is the same form as the request for cancellation. So you just keep certifying your employment until you hit the 120 mark and then they cancel it. Because of that, there was a huge spike in applications, and the student loan servicer, MOHELA, that processes these, has a significant backload. So they're taking much longer to process PSLF forms than they typically do. With payments resuming and the stress on that system, and apologizing for them, I think it's a huge problem, but just being realistic, it's not clear when that backlog will get, or when the time frame will get better. The backlog will get cleared, but are they always going to be this slow is sort of the question, right? So if you're waiting, make sure you have records of what you submitted, when you submitted them. If it's been over a year, that's probably too long. And so if you can file a complaint with the ombudsperson in federal student aid, which is the part of the Department of Education that handles this, that would probably be helpful. So if you just Google sort of the FSA ombudsperson and complaint, you'll get to their government website and can file a complaint there. But there are many month-long waits on the PSLF processing. If you think that you have the 10 years and you're really just waiting to get your debt canceled, maybe maybe you're a good candidate for the on-ramp and to not make a payment because you're going to get your debt canceled. If you're not sure, I would just recommend instead you get into the SAVE plan. And if you're someone who's not at the 10 years, you're going to need to continue to accrue it. So just continue to work, continue to annually recertify, even if you're waiting to hear back.
Thanks, Winston. What if someone is currently enrolled in public service loan forgiveness, but they're approaching retirement? What should they consider?
So unfortunately, the way the public service loan forgiveness program works, and this is sort of, blame Congress, because it's in the law, is you have to be currently employed in public service when you apply for the forgiveness. So if you are retiring and already have the 10 years, you should be okay if you've already applied. But if you have only 9 years and you're retiring, then you're just not going to be a candidate for public service loan forgiveness. Or if you switch to the private sector before you retire, same thing. You need the qualified employment. But if you can get the application in before you retire, you should, the rules allow you to get the cancellation even if you're no longer currently working, but make sure you submit the paperwork while you're still employed.
Thanks so much. What if someone is, can you talk about how PSLF and teacher loan forgiveness, which is a different program, how those things interact and what you can do?
So teacher loan forgiveness is a different program than PSLF, but it allows for a certain dollar amount of cancellation, whereas public service loan forgiveness is complete cancellation of your federal student loan debt. The relevant overlap is that you need to be, for both, working in a qualifying job, and it can be, if you're a teacher working at a nonprofit or a public school, that's the same job, right? To be a teacher loan forgiveness, you need to have a certain teaching job. That job almost always also qualifies as work for public service loan forgiveness. The thing is, you can't double count months. You sort of have to say, I've worked here for 2 years and I want to use those 2 years of credit towards teacher loan forgiveness, or I want to use those 2 years of credit towards public service loan forgiveness. Teacher loan forgiveness gives lower dollar amount of forgiveness, but on a slightly faster timeline. So depending on what your balance is and what your personal circumstances are, it might make sense to apply for teacher loan forgiveness over public service loan forgiveness. But if you're sort of have a big balance career teacher, you're going to be in it for a long time, so you're not worried about having an ineligible job at some point, public service loan forgiveness might be better because you can get your whole thing canceled. But again, if you sort of go to look at studentaid.gov and look at their teacher loan forgiveness page and their public service loan forgiveness page, you can, based on the FAQs there, figure out which is the better fit for you.
Thanks, Winston. Is there a way to tell how many qualifying payments you have before consolidating, or are there things that you should consider before consolidating?
So part of the frustration with the federal student loan system is that it's been historically very poorly administered, which means it's hard to get records and information. What you can do if you go to your, and on the slides I showed this, and it'll be in the recording, if you go to your dashboard and then view loan details and download my aid data, you can get a sort of text file running list of each of your loans and when your loans were in different statuses. Like I'm in, repayment, forbearance, deferment, those things, right? You can look at that and figure out how many months you think you'll get through the IDR account adjustment or where you're at in general. That's a very technical in the weeds way of doing it. Unfortunately, right now for IDR, for example, there's not like an IDR like ticker on your account. They are going to add one, they say at some point in the next year, so that you can actually say, oh, I have 18 years worth of IDR credit, it looks like, without having to figure it out for yourself. They don't currently have that. If you have already done PSLF, there is that PSLF counter on your, if you've done PSLF already, like if you already certified some employment, your loan should already be with MOHELA, who administers PSLF. If you formerly FedLoan did it. They do have a PSLF counter there, and that can be helpful. But if you have like a pending application with them, that counter won't reflect the credit that hasn't been calculated yet, that hasn't, your most recent credit that hasn't been added yet. So the short answer is, if you know what to look for, you can go into your own records and figure it out, but it's pretty complicated. But soon, as a part of their servicing features, your student loan servicer should let you know what your IDR credit and what your PSLF credit looks like. Unfortunately, not really soon enough to know by the deadline this calendar year, but for most people, there's not much to lose by consolidating. Again, Parent Plus borrowers are one population who should take a second look. There might be individual circumstances, but under the current program, current law, most people will benefit from consolidating by the end of this year.
Thanks so much. And on Parent Plus loans, who has to work in public service in order for the Parent Plus loan to qualify for PSLF?
The parent does. So the parent is the borrower. The fact that they use that loan to pay for their child's education and their child's job is not relevant for the parent's Parent Plus loan. And your spouse's job also doesn't matter. It's like, whose loan is it? Whose name is on the loan? They're the one who has to work in public service for 10 years. And again, what makes public service for Parent Plus, PSLF for Parent Plus loan borrowers so complicated is that the plan that counts towards PSLF on a standard Parent Plus loan is the 10-year plan. But that's as long as it takes to get cancellation under PSLF. So you're sort of paying down your loan on the same timeline it would take to get cancellation. So in general, for most people, you'd have nothing left to cancel. That's not true at this moment in time because people got 3.5 free years during the payment pause. And so a Parent Plus loan borrower on the standard plan could get cancellation after only 6.5 years of payments, right? Actual payments. What makes it complicated is if you then consolidate your Parent Plus loan to get another payment plan that is eligible for PSLF, one of the IDR plans called income contingent repayment, or ICR, that will count for PSLF, and in theory might leave a balance to get canceled after 10 years, but is often very expensive for people. We talked about the federal poverty levels and 150 up to 225 and 5 or 10% after that. ICR is just 100% of the federal poverty level. So it's just the poverty level itself. And then it's 20% of above that. So that ends up being significantly more expensive than the other plans, but it's a very case-by-case analysis to know whether that's affordable for you as a Parent Plus loan borrower to consolidate and whether there'll be anything left to get canceled after PSLF, after 10 years. So that's, a little bit more than the actual question. That the answer is everything is about the borrower themselves, not their spouse, not their child, but that was just to get into some of the intricacies around PSLF and Parent Plus loan cancellation.
Thanks so much, Winston. Yeah, I'm just letting people know that we are getting a ton of questions, so I'm trying to consolidate and get as many of them answered as possible. I think
we probably have about 5 more minutes, and then we'll turn it back over to Ben to sort of close things out.
Yeah, it looks like we have maybe time for one more question. I think, would you mind reviewing kind of what to think about if you are trying to get through Fresh Start? You know, can those folks get into the SAVE plan? What are the steps that they need to take again?
Yeah, so once they take the steps, they can get into the SAVE plan, but they need to either call the company that is servicing their loans. When you default, your loan gets moved to a separate special default student loan servicer. So you need to contact them and ask to benefit from Fresh Start, ask to get through Fresh Start. You can go on studentaid.gov and see who that company is if you haven't gotten communication from them. Or you can try to go back to school and request federal financial aid, and that will trigger Fresh Start for you. And once that happens, yes, you'll have access to all the typical student loan payment plans, including SAVE.
Amazing. I think that might be all the time that we have. I'm going to pass it back over to our friends. Hi, Ben.
Hey, well, thanks. That was a lot of great information. Thank you, Winston, and thank you, Amy, for going through all the questions. I know there's a lot of remaining questions that we aren't able to get to. So I do want to once again share our information, and you can schedule individual appointments with our office here at DSB. And that's with the dcloanhelp.dc.gov. In addition to that, we will be distributing the presentation and having that up on our website and OAG's website. So in closing, we would like to thank everyone for their time and participation in today's webinar. A big thank you goes out to OAG, DCHR, Student Borrower Protection Center, Mayor Bowser, for putting on this great session. As everyone's aware, there's been a lot of information that's been shared, but once again, don't hesitate to reach out to us or check out our website at disb.dc.gov for more information. We have a lot of Q&A information. We have previous webinars. We will have this webinar. And in addition to that, we just launched our new student loan borrower curriculum, which kind of walks you through 7 different modules on where you are on your kind of student loan journey, starting from repayment to consolidation to PSLF, and then, you know, into discharge and forgiveness. So once again, thanks everyone, OAG. This was great, and we really appreciate it and look forward to assisting you. Thanks again, Winston.
Thank you.